On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
22 minutes to 5. Luke Smith, good afternoon.
Good afternoon.
What a cracker of a day.
Oh, it was an absolutely belter of a day, and little could be said for the golf that was played.
Well, you can't have everything, can you?
No.
No, the weather was good. That's all that matters.
Yes.
Today
much so.
we're going to attempt to answer a very interesting question.
Yeah.
Should I buy an investment property like everyone else? Well, my first thought is no, be unique, buy a different investment property. But anyway, do people actually ask you this question? Is this what what they're coming up with?
This is exactly why we're talking about this, because I think people do this because they have no other idea what else they could do, or there's this fallacy that if I can touch it and feel it, it's risk-free. So today we're going to break down the pros and cons of something. Now, we're not saying this is a good idea. We're not saying it's a bad idea. But I think people need to make more informed decisions about what they're trying to achieve over trying to buy an asset and then retrofit it to an outcome.
Yeah.
Because you could be sadly mistaken. And more often than not, I've had, 4 times this week, I've had people come in and go, look at all these properties. Look how rich I am. And I go, cool. How are you going to fund yourself in retirement? Oh, well, I can't because they're all geared and I don't get any income off them. Okay, so the need for this property is going to change. So you can buy something with the best of intentions, hold it for the longer term, get some growth, get some rent, get some deductions. I wouldn't buy something for a deduction as the primary objective, but if that's how you want to roll, that's fine. But then there comes a point when you retire, you walk in, sit down in front of me, and I say, what do you need to live on? And for the people that shock me and give me a number because they've thought about it, generally speaking, the yield you get out of some properties, and I go some, the property advocates out there will, but everything has its own situation, its needs, and its performance. But a lot of the time, people need to be thinking well in advance of retirement what they're going to do with an accumulation of properties, because when you sit down and do the numbers on an after-cost basis, the rent is not providing a yield that you would expect, and they are extremely illiquid. So if you do want to go on a $100,000 holiday, it's very hard to sell the kitchen of one of your houses. So we're going to talk about the pros and cons of considering that, and it's probably a good segue into, well, what are some of the pros of picking up an investment property? Well, with any asset that you purchase for investment purposes, the money that you borrow is generally tax deductible. Now, that's a great idea because that will offset the taxable rent that you generate. And the same could be said for dividends from investments. So it's not that we're saying that borrowing for property is unique. Anything that you borrow for that is for investment purposes that generates assessable income is generally going to give you a tax deduction. But that's one that people really like. The other thing is that you can leverage a physical property at a much higher ratio than you can a share. So you can go and buy $1 million property and borrow $800,000, or generally 80%, sometimes more. But I think we're getting into a realm of just stupidity doing things like that because you're stretching the elastic band way too far for the sake of doing something. If you need to leverage that much, you probably can't afford it to start with. So people like properties because you can borrow a truckload of money to get into a type of investment, whereas leveraging a share, you can't generally borrow to the same amount or percentage. So it's greater from a leverage perspective. The perception is, well, I can touch it and feel that it's less risky. I'd argue that's just a silly comment because every asset and everything that people do from an investment standpoint has its own unique considerations in relation to risk. And just because the risk is different to another type of investment doesn't mean it's more or less risky. So you need to take something on its merit, and gearing can be dangerous. Gearing can also be very effective in any asset. The rental income people like because it'll carry or meet carrying costs or holding costs, agents, expenses, and things of that nature so that you don't have to put your hand in your pocket. And that will be a direct impact on or result of the level of borrowing that you maintain on an asset. So people like the rental income because over time you can pay it down and then you can use that rental income to fund yourself in retirement. I generally find people walk into my office and go, okay, these things have served their purpose. Now let's start selling them to move money into superannuation or to get a better income stream off them. Because the one thing that we get belted with here in the ACT and in a number of other states is ridiculous amounts of land tax and other things that reduce the net income that you receive from an asset. And we'll see those pop up in the cons section in a little bit. But it's important to remember that if you're going to borrow and claim a tax deduction, you need to work out the tax benefit for your situation.
Yeah.
Okay, so if you've got $20,000 of rent and you've got $30,000 of interest, you know, you hear the negatively geared term thrown around, and there's people that think that's wonderful. There's people that actually do the math and go, all right, because I don't think it's the golden goose that everybody carries on about. Now, there'll be people that are pro and anti that comment. Fine. Everyone can have an opinion. But for me, it comes down to the maths. If you're going to be negatively geared at a lower marginal tax rate, it is far less appealing than somebody on the top marginal tax rate.
Oh, yeah, yeah.
You know, so again, you have to look at the impacts of negative gearing. Whilst they can be good, you need to consider your situation, not what your parents thought was wonderful when they operated in a completely different tax environment 35 years ago.
Yeah, I'm certainly of the opinion that negative gearing is a bit overrated, particularly when you stop and consider that what it actually means is you're making a loss. And sure, there's a tax deduction for making a loss, but wouldn't you be better off if you made a profit and maybe if you paid more tax, but you still have more left over at the end? So
Exactly.
you know,
and again, I don't have
taking a loss is not necessarily a great strategy.
Exactly. You know, I look at it simply and go, I've got a $10,000 negative position on an asset, so that if I've got a marginal tax rate of 34%, so I'm spending 10 to get 3 back.
Yeah.
Really? So the property's got to go up 7,000 in that example just to break even. But they're the sorts of things that are never considered.
That is why people do it. Of course, they expect a capital gain at a later stage, and one hopefully will outstrip the other. But it's a bit of a roll of the dice, isn't it?
Well, you've also then got to turn around and say, well, for my tax position, is it worth it? Because it'll depend on your cash flow. It'll affect your cash flow. It'll also affect the value of the strategy that you're undertaking, because the one thing you do need with anything to do with a property is time.
Exactly, yes.
You need time. So
Yeah.
you're going to be carrying that loss for a significant period of time. And here's another misconception is, oh, well, I'm going to get deductions, But if you get a property paid off to the point where it's neutrally geared, where rent covers interest, there is no longer any tax benefit.
No.
So you've got to be really careful what you wish for, because people always come in and say, oh, I want to pay down. That's great. But then I ask them why they've got it, and they'll go, oh, for the tax benefits. Okay, but if you pay it down, you're eroding the tax benefit. Because we come back to, you've bought the asset to retrofit an outcome that doesn't fit.
If you have other debts, you'd pay those down first.
Yeah, like if you want to hold something neutrally geared, I'm all for people doing that, no problems. If the rent can cover the holding costs and you can park it on the shelf and let it sit there for 20 years as a generational asset for your kids, great. You want to sell it in 15, 20 years when you retire, great. But think very carefully about, I'm getting a tax deduction, because if you don't pay it off and you've got an interest-only loan, which isn't a bad thing, you might be $7,000 out of pocket for a 10-year period, and you may or may not see the capital uplift, or then result in additional tax being paid from a capital gains perspective when you sell it. So people really need to do the numbers. I think a lot of people buy these things, and get me wrong, I'm not against buying properties, all right? But don't buy something for the wrong reason, or understand the implications of the long-term holding of said asset, because the one thing I do find people get really upset about is something that impacts their cash flow over an extended period that may have relatively no growth. You've also got to remember that houses at the moment are trading at record levels. And as a proportion of household income, the stat's something like 16 times household income, which is unbelievable. So you want to race out and gear something in the highest environment it's ever been just because somebody 4 generations ago said, it'll double every 10 years? Really?
You see, that is a very widely held assumption. But of course, the thing with generalisms is that they don't always hold true.
Totally.
And we've all, if we've lived long enough, we've seen extended periods where real estate prices were flat or even going down for a long period of time. So 8-9 years at one stage.
And I've had plenty of people walk in my office and go, oh, look at these 10 places.
Yeah.
And they might have 3 good ones. They'll have 2 or 3 that are horrible, and they might have 2 or 3 that go sideways. So again, it's a law of averages, right? You diversify an investment portfolio because not all the shares go up at the same time. No. That doesn't mean they're good, doesn't mean they're bad. It's just that moment in the sun, they either shine or they don't. But as long as you've got plenty of time to do it, it's very much a long-term play because, if we jump to the cons, you've got holding costs, you've got taxes, you've got rates, you've got land tax, you've got all sorts of silly things that erode the value of something.
Yep.
You've got legislation now that is ridiculously slanted to the tenant. And I think the people that are carrying all the risk are missing out in relation to elements of control because this perception of a downtrodden renter, I think, is another fallacy. I've got plenty of successful clients that rent, and this perception that renting is bad, I think, is another horrible generalisation from a legislation perspective. And I think the person that's carrying the rent, the risk, and has borrowed the money and has to maintain the asset and deal with the tenant, their rights should be protected far more than they are. And I think it's a huge disincentive, especially here, to have an investment property. I think you need to remember that maintenance and upkeep are going to be more than you think.
Oh, yeah.
You're also going to have a tenant that doesn't care because it's not their place.
Oh, yeah.
And it's very easy to go, hey, just come and fix it. And if you're not careful, the other big misconception that I have is, oh, well, I get depreciation. That's amazing. But on what? And at what rate? And for how long? And the other thing that people need to keep in mind is you can claim depreciation all the way along you hold an asset. Great, wonderful. Look how good that does for the net tax position of your return. But you've got to pay the piper at some point because the depreciation you claim then reduces the cost base.
Yes.
At the time of sale for an investment asset, so you pay more capital gain. So you get no free lunches here when it comes to getting punched in the mouth with costs and expenses. So I think people need to go into these things far more aware that things might double every 10 years, but you're talking houses in streets, streets in suburbs, suburbs in states, that sort of generalisation. I have plenty of people walk in and go, that's gone nowhere for 7 years. Mm-hmm. Okay.
Exactly. And it does vary a great deal from locality to locality. It's not a hard and fast rule by any stretch. Luke Smith from Envision Financial is with me in the studio today. We'll be back with more in just a moment.
C.
7 minutes to 5 now. Luke Smith from Envision Financial is with me in the studio. And today we're attempting to answer the question, should I buy an investment property like everyone else? Well, given everything that we've discussed so far, the answer is not necessarily.
Well, I think the answer is it depends on why you're buying it.
Yeah.
Because again, it's we're not talking today whether it's a good or bad thing. I just find that a lot of people race to it as the port of no other option or no other consideration, when there are plenty of things that people could do. Because the other thing we didn't touch on before the ad break is, are we talking about a unit? Are we talking about a house? Are we talking about a townhouse? Are we talking about strata? No strata? Are we talking commercial? Are we talking industrial? So when I say property, you can buy just about anything, and they all have their merit. But people seem to gravitate to buy a unit, buy a house. Now, I'll say something about units. When you've got too many bananas, does the price bananas go up or down?
Well, if you've got too many, it probably goes down.
Are we short of a unit?
Not really.
Okay.
Here in Canberra, especially not really.
Keep that in mind when you race out and go, ooh, it's cheap. It's cheap for a reason.
Yeah.
So it's a marathon, not a sprint. Remember, generally it's a long-term hold, so buy a good quality asset.
Yeah.
Better quality asset, potentially better quality tenant.
Yes.
Better quality tenant, better quality rent, better quality yield.
Yep.
Great. Laws change. Okay? Remember, laws change. And they generally don't change in the hard-working person's favour. All right? So whatever you're banking on, remember, it could be touched. And depending on what you believe, depending on what you read, they'd love to get rid of negative gearing. They'd love to get rid of CGT discount after 12 months and reduce those benefits. So if you're holding a portfolio of that and there's talk of that legislation changing, Do the numbers, because it's going to make a massive difference on the net return of what you hold and may change your perception or timing in relation to how long or how short you hold something. Have a buffer in your cash flow. So when these property spruikers model something and go, oh, look, on an after-tax basis, it's this. Just remember, you've got to fund something. What is the funding cost of this place? Don't worry about your depreciation and all the other things, because that's wrapped up in a tax return. Yes, you can look at it like that, and that is fine. There's nothing wrong with that. But I often have people come in and go, oh, but they said it'd be cash flow neutral. Well, on an after-tax basis, when you consider depreciation and everything else, it might be. But you've got to fund this during the year from your physical money. So build some buffer into your cash flow, because rates go up, rates go down, costs go up, costs go down. Don't believe strata costs ever go down.
No, they do not.
So again, think about that, because you can guarantee there'll be a building somewhere that needs to be reclad. From a negative gearing perspective, do the numbers on your tax rate, not what mum and dad says, you're going to get 50% discount. Well, mum and dad might have been on the top marginal rate. You're probably not. So work out if you're going to get a 34% discount, a 39% discount, whatever it is. Work out the tax benefit at your marginal tax rate. Don't assume it's just, we get 50%. Rental income and net asset position also include for Centrelink purposes. So if you've got multiple assets and you get to Centrelink age, they're going to be assessed under the income and asset test, so don't think that they're exempt. Remember that you have to pay something off over time that you hold it to be able to get the rental income to fund lifestyle.
Yes.
So if you're going to hold something with a long-term view, pay it down correctly, get your loan structured in the right way, have interest only, have principal and interest, have the loan that's right for you. And remember that managing your cash flow is more important than the rate that you pay. So as long as you go into these things with your eyes open and consider the why in relation to the purchase of the asset, I think it's a wonderful opportunity to hold something long-term, but do it in the right structure, get it in the right name, think about disposal, not just the deductions along the holding period, because I find a lot of people come in, it's 99-1, and then the person selling it gets absolutely belted from a capital gains tax perspective, when if they'd owned it jointly, they may have been far better off when they dispose of the asset. So keep those things in mind, and you can be very successful holding a property portfolio.
So, Luke, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got the back catalogue of all of our shows. And we've got Smart Money Strategy, your ultimate guide to financial planning, in all good bookstores.
Fantastic. And duck out to the bookstore tomorrow morning, because it's Father's Day on Sunday.
Great idea.
And thanks very much.
Ben.
Luke Smith from Envision Financial will be back with us in the studio once again at the same time next Friday afternoon to talk money matters once again.